now moved into the red. The mid-cap index too, which is outperforming, is significantly off the highs of today's trading session. So we are seeing some sell-off and some choppiness for the markets. Amidst that, there are a bunch of numbers that have come by. Cyient DLM reported a good set of third quarter numbers. The revenue came in strong while margins contracted marginally. The company saw a revenue growth of 75% in their aerospace and defense segment on a year-on-year basis. So we do have with us Anthony Montalbano, who is the CEO of the company, joining in. Thanks a lot, Anthony, for joining in. Earlier, I remember you had guided for almost 40% growth for the entire year. In the third quarter itself, you've done 50% and strong business coming in your aerospace and defense segments. What do you think is a sustainable trajectory of growth for the company for this year? 40% plus is on the cards given the strong performance that you saw. And in defense and aerospace, what's a sustainable growth number?
Thank you. Yeah, it's great to be here. And yeah, I think the percentages that you've highlighted are exactly in line with the plan that we have laid out for the current year. And as we're looking out in at least the next 3 years. So these segments continue to be very strong for us, and our end market demand is really along the same trajectory from when we kicked off the fiscal year. So overall, I'd say it's pretty much in line with the numbers that you've highlighted.
Okay. Anthony, hi, welcome to the show. Well, your earlier guidance was that you'll probably exit FY24 with around a 40% growth. Are you sticking to that guidance? Do you think that you can probably improve on that? And then you'll probably get into FY25 with a high base as well. So what is the possibility, or what is the outline of growth that you have in mind for FY25?
Yeah, so I think we would probably discuss FY25 as we finish our next, as we finish the current quarter that we just started, right? So I think that's maybe a better discussion as we finish Q4. But as we're into Q4 now and the outlook that we have, yeah, we are looking at the growth rates that we've highlighted, and we do see that trend to continue into FY25 as well.
All right, we did see an order intake of nearly $42 million for the third quarter. Could you give us a sense of what your overall order book is at right now? What's the kind of order intake that you're targeting for the quarter that we're currently in, that's quarter 4? And how does this order book behave across segments? Because while there was strong growth that came in aerospace and defense, industrial and medtech were rather weak. So what is your order book split? Where are the orders coming? How does that pan out?
Yeah, so our business right now is a little bit heavy on the defense when you look at the percentage of our revenue, right? And that's due to some larger contracts that we're in execution mode right now. This is a couple-year contract. We do have a very solid aero pipeline, right? Our pipeline overall is quite solid, but then aero is a big part of that. Defense and medical also, medical and industrial are also segments that are here as a focus, and that we do have some opportunities that we will looking to be closing in the near term that will add to that. So as our business grows, medical and industrial will start to make up a larger percentage of that share. Aerospace will continue to be a significant part of our business, and defense will, as a percentage, will start to decline a little bit in terms of the overall pie.
Ideally, what is the order book? What is the order book?
I'm sorry, the specific, I don't think we're getting into the specifics on the exact numbers that we're looking at, right? So I think what we released in yesterday's guidance is what we can discuss.
Right.
Okay.
Or yesterday's numbers, yeah.
Anthony, the last time we spoke, you had indicated that you were not seeing any sort of disruptions coming in from Israel. And that was in October. That was, pretty much the start of the issue. And you get around 20% of your business from the Israeli markets, if I'm not mistaken. Has anything incrementally changed, considering that there are disruptions which are taking place in the Red Sea as well?
Yeah, so it was definitely a point of concern, and we're pleased to inform that there actually has not been any disruptions at all, right? So even early on when this took place, we did reach out to the key suppliers, and there was no disruptions forecasted from them at that time, and we've not seen any. There have been some, minor costs of logistics, transport costs, but very, very minor impact in that regard. So overall, we're actually pleased that those disruptions have not materialized. And also, it has created some opportunities for us as well, as far as some defense work that we continue to grow.
Can you quantify that, the opportunity?
They are with specific clients. So I wouldn't say I would say it's moderate, right? It's not like it's a substantial increase, but it is something that we did not have in our initial forecast. And so there's some, what I'll call some upside that I think that's come due to the nature of the events in that region.
Right. What about margins? I mean, margins same time last year were in double digits. Now they're around that 9% mark. When do we see them go back to the double-digit mark? And a large part of your capital is stuck in working capital, because working capital days too are closing in on nearly 120. You had a target to bring that down by almost a third. When does that happen?
Yeah, exactly. So on the working capital, that very much is the case. We will be bringing that down. I think as we look out into the next quarter, we do forecast some improvement in that regard. Part of that is due to the business mix that we have with our clients. That is also similar from a profitability perspective. So yes, we do target, we do want to be operating at about a 10% EBITDA. Right now, we're a bit shy of that. That's due to investments. It's due to some order mix that we have. Some of these larger programs on the defense that we are shipping at high volumes right now are being a little bit dilutive in that regard. And then also some exchange rate aspects having a little bit of an impact. So we do see the business overall, though, aside from this quarter, does need to be operating at about in double digits at about 10% EBITDA.
All right. Any update with regards to inorganic growth? You said that you are in discussions the last time we spoke.
Yes. So what I can articulate is that we actually have made some good traction since then. So this is an important part of our overall growth strategy. I mean, all the numbers that we've been discussing so far are organic. Inorganic will add to that, and that will add as far as it will add to capabilities and footprint, and also likely some diversification in the segments. In the segment mix that we have. So we hope to be able to get into some specifics on that here in the near term. So, but again, we are pleased with progress in that regard.
All right. Anthony, thank you so much for joining in. Wish you good luck for the remainder of this year. More importantly, for FY25 as well, as you scale up your business. We will be waiting by to hear on that inorganic opportunity, and perhaps some more light that you can shed on improving margins and the business too. Thank you for joining in.